I'll just try to explain it in the next. So just to what is the interplay between 452 and 8I8N. So in the first situation we have seen that actual payment rate is 95. The ALP computed is 100. So whether there can be any disallowance under 452, clearly no. And whether can there be any adjustment also under 8I8N? Again no, because you are still falling within the interquartile range. So 100 is your ALP, which is the arithmetic mean, as we build normally, and that's the range. Second situation, payment is 102, the ALP is 100. So whether there can be any disallowance under 452A. So forgetting the 3%, in this situation there can be a disallowance, and of course then there will not be really disallowance under 8I8N because it will get disallowed under 452A itself. Then coming to third, where we are 110 is the payment, ALP remains 100. So whether there will be under disallowance again here, yes, here also of course in the interquartile range or otherwise will really not help, and 8I8N will also not. And in contrast to that, if you look at the last one, where 85 is the payment, okay, ALP is 100, and the interquartile range is 92 to 105. In this situation, you will get hit by 8I8N because what your ALP it is less than the ALP and it's actually well below the interquartile range. So in that situation, you may get hit by 8I8N. So that's the interplay between the two. I think this was your question, and I just answered that effective when you this provisions will trigger. So from initial assessment year, once it's an initial assessment year, etc. And even though if there are losses, the question which was asked, even if there are losses, one will have to justify once we have started that period. So again, this is some example that if you have in the first 1 to 5 years I have not claimed or I have not opted for it. 6, 7 also I have not opted for it, and I have started from year 8. So there was profit. In that situation, STT will apply. 12 is that if after the initial year there is a losses, so therefore one will have to apply STT, because when you start from 13 to 15, when profits start, you will have to set out those losses. So of course, this is just giving what is the impact if one was not to apply the provisions. One would have claimed higher, which is not permissible. As I mentioned, I think when it will come to TNMM, wherever when situations will come when one will have to go to resort to TNMM, I think that is also going to pose its own challenge, because as I mentioned, particularly when you are doing profitability, determining profitability for the eligible units, you will never find comparable data in public domain entity-wise. There may be other companies which you also may be aware, but that entities may be having both eligible, non-eligible, etc. So that's going to be a challenge as to how we are going to break up those segments. Again, we had losses, as I mentioned, when losses are benchmarked, whether profit making compared to companies will have to be taken into account, which is going to be a challenge. So I see that as far as this incentives, etc. go, I think one will have to rely more on the general principles, etc. Gap and find out more and more business reasons and try to build up, because ultimately benchmarking, yes, will have to be done, but then I think a lot of subjectivity and adjustments will have to be made to the comparables, margins, etc. So somewhere I think this will have more adjustments to be made as compared to what we are doing in the case of international transactions today, because this is going to be a challenge. Again, I think the issues will come is whether this sections which are where if one has to look at 8IA6 and 8IA and etc., it covers various sections. But 92DA specific dealing with SDT, one, it does not cover 35 AB, 7 etc. So therefore, I think one can go strictly as per the law. I think somewhere, at least I was unable to find that. I think there will be still some taxpayers who will still be following, that last year of tax holiday 10A, 1A somewhere, one more year possibly. I was struggling to find because nowhere any of the sections 10A, 1A has been covered when it comes to SPT. But I was unable to be very honest, unable to find this. But if there are, I think possibly having regard to the intention, etc., one may look at it again, from a market year, etc., and penalty, whether if there are such situations, we need to do any STT compliance. I think this was one, and this was a very specific case which came up was that the company, there was a company and another related party which was setting up some units, some unit in the ACL. And what happened was that there was a core team in company one who was actually running this business, and it was so core that this unit, which was also in almost similar business, these people were actually transferred from company 1 to company 2. And we all know that I think in software industry, etc., people are regarded as fungible in that sense. But those people were so poor that this SEZ could not have started running. Could not have been set up and started doing the business without these people's involvement. Therefore, the question comes is that if there is no charge, normal, the cost, etc., may get reimbursed, the cost of those employees, etc. But there was otherwise no charge from company Z to company I. Then whether the tax office can therefore allege that, these people have been responsible for the setup initial period they were running, whether they should have actually paid some additional consideration for this. I think this is a very unique situation, but I think, in my view, I think somewhere, one will have to look at the new GST provisions in that, because that is so core to SEZ. So I think there could be, so-called unique intangibles, etc., which may be getting transferred or whatever. I think one will have to see. There, I don't think one can take a position of that, I'm not in that business, etc., because clearly company I is not in business of providing people, but as far as, because if you look at, the provisions, etc., they talk of justification from the recipient side, if you will see. So I think this is one, again, it's a unique situation, so one cannot just apply, the law blindly in that sense. Again, typically you have this lump sale, etc. If there are, I just complete one. Yeah, sorry. Earlier slide.
The previous one.
Yeah, please.
Actually, can one take an argument that each assets or resource assets are not accounted for in the books? So maybe it will not cover tangible or intangible assets, therefore not falling under the provisions.
No, I agree. You are saying that this is also not a depreciable item. Are you trying to say that?
No, in the sense that there will be so many. HR is of course a very significant aspect of software industry, but fundamentally when you are talking of goods and services, you are talking of assets. Now there will be so many items which are off the books. HR is just one example. If one were to go to all of them, so many complications could arise. So can one not extend an argument?
Here, as I said, the only thing was that those people were so keen to set up and running the business. So that was very clearly so. Actually, they were providing some services in that sense. Could be a marketable. See, it has the potential of being a marketable service. Because if I start doing this business itself, even to other entities around, I could do that. But we were so poor, and this was something live example which we saw, and finally somewhere we came to the conclusion that this may the ordinary principles may not hold true. Again, so that's the last, so that I can complete in time. Is the sale, some sale happening, from, and assuming that, the reconstruction and all those conditions are getting fulfilled. So if there is any, some sale of any assets going to the eligible unit, again, I think one will have to, comply with the provisions, because again, it's a question of depreciation coming. But again, just to on this, that if it is, it should be an eligible expenditure. So once you start claiming it, etc., everyone will have to do the compliance. Okay, that's exactly that was. So any questions? I think I try to get one time. If there are any questions, I'll be happy to.
We can take 2 questions.
Will it be extended to other common expenses like plant building, modeling, corporate advertisement, advertisement and marketing, promotion expenses?
See, sir, that I think in any case today also we do. I don't know. We are not going to do something different. So if it's a advertisement done at a corporate level, we do some kind of allocation. Today also on normal gap basis or segmentals or whatever we do, following the segmental principles, etc. Then it will be more of a cost allocation. Then really benchmarking may not really become necessary. One may only say that you should have allocated based on the cost or the revenue or whichever, or based on the cost, say for example advertisement. If there are marketing people sitting in the eligible unit, dedicated and non-eligible unit, and the overall, then you do it on the ratio of that cost, etc. But it will be more of a, you really did not really get into some kind of a benchmarking independent. That was, but in the situation which I was describing, it was very unique. So that's why the question was whether you need to have some kind of a consideration, because the cost was in any case being reimbursed. So over and above that. That was the situation.
So practical question, if there are 8 eligible units, and for benchmarking and reporting, they have to aggregate all of the 8 or individually?
In fact, I was with the council yesterday, and of course that was in the pre-SDT area. How do we do this, because there was some peculiar situation. Now, I think the forms, etc., which also talk of some initials, etc. Now that initials can be for all units, or I have actually I think either way it could be, but I think the safer will be you get it for all 8. In any case, it's only a question of filling up the form. Now, the initial computation is already there. Then why you should take any chances?
I applied it for all the units.
Of course, client will not pay you. I don't know how they will pay you, but of course they should pay you.
Thank you. Friends, we are at the end of the technical session. You have understood the interplay between SDT and international transaction in the first session. Then you understood the interaction between you have understood the interplay between 40I transaction and the 80I transaction. Now you understood interplay between 80I and 40A2 transaction. Also the specific issues of the tax incentive companies and how fair market value could be adjusted. And with that I think you have learned a lot. Most of the objective of the conference is very well served with this session and one more session to go. And then finally we will have a panel discussion which will revise the entire course perhaps what you learned through the day. With this I request Dinesh to suppose that we will resolve. Thank you.
So we are thankful to you for spending your valuable time today.
So we are thankful to you for spending your valuable time out of your busy schedule and also during the AP season going on. We are once again thankful to you for lucidly explaining the issues related to benchmarking various transactions with respect to tax holiday units with the help of practical examples. With this, I on behalf of Chamber of Tax Consultants and member present here propose a hearty vote of thanks and request you all to carry out with this round of applause.
Thank you. And I've given my contact details. Please feel free to write to me. I'll be happy to answer the question.
There will be reshuffling of the dais and the next session will be starting immediately.
There is no break, please.
Please be seated. We are starting the session immediately. Welcome to this fourth technical session. In this session, we will be having the benefit of learning from a learned faculty on importance of FAR, that is FAR analysis and compatibility analysis, selection of most appropriate method, and issues in disclosure in new form 3CEB from SBT perspective. And to deal with this topic, we have with us Shri Pramod Joshi. It's my privilege to introduce this learned faculty before this August gathering. Mr. Pramod Joshi is a chartered accountant and also a law graduate. He is a senior director in Dera Glassings and Sales and is based in Pune office. He has got about 15 years of experience in international tax, including transfer pricing. He specializes in international tax and transfer pricing and expatriate taxation. He advises clients on various tax issues, including tax planning, strategies, and taxation of foreign enterprises in India. He has regularly represented various clients in assessment proceedings before various authorities and has argued a number of cases before the appellate authorities as well as before the DRP, the Dispute Resolution Panel. He has been a regular contributor in the professional journals and has been speaking at various forums like National Academy of Direct Taxes, Chamber of Commerce, Institute of Chartered Accountants of India, etc. With these brief words, I present before you Shri Pramod Joshi, and I request all of you to welcome him to the Lord. Before I request Shri Pramod Joshi to deal with the topic, I would request our Vice President Anas Bhai to please offer a memento to Pramod Bhai as a part of our love and affection. I would request Pramod Bhai to address us, please.
First of all, we sincerely thank Chamber of Tax Consultants to invite me to speak on one of the sessions for your today.